Inflation in the United States rises to 2.7% in November. World Bank estimates Lebanon's real GDP growth has been cut by 6.6% in 2024. And OPEC lowers its 2024 global oil demand growth forecast to 1.61 million barrels per day. Welcome to the Economic Bulletin, where we present comprehensive coverage and expert insights on the latest economic trends and developments. And welcome back. Data from the Bureau of Labor Statistics shows that the United States inflation rose to 2.7% in November, slightly up from October's 2.6%. Data showed that core inflation, a measure that strips out volatile food and energy prices, increased to 3.3% over the year ending in November. Food prices rose 2.4% in November compared to a year ago, matching the previous month and marking slower price increases than the overall inflation rate. On a monthly level, the consumer price index grew by an 0.3%. U.S. President-elect Donald Trump has announced selecting Andrew Ferguson as the head of the Federal Trade Commission. Ferguson was praised by Trump for being a strong advocate of America's first policies and innovation. Trump emphasized Ferguson's record of challenging big tech censorship and defending freedom of speech. In a separate post, Trump also revealed his intention to nominate Mark Meador to join the Federal Trade Commission.
Thank you.
And elsewhere in the U.S., President Joe Biden defended his economic record and urged President-elect Donald Trump to continue his policies. Biden highlighted America's strong economy, noting that Trump would inherit one of the strongest in modern history. He acknowledged challenges such as inflation and high living costs, but emphasized his administration's efforts to bring inflation down and increase wages. He also pointed to job growth, infrastructure funding, and renewable energy investments as key events. He challenged Trump to build on this progress rather than revert to past policies.
It was long past time for America to make a generational investment in our infrastructure, in our manufacturing base, the technological edge in our clean energy future. I know it's been hard for many Americans to see, and I understand it. I just trying to figure out how to put three squares on the table. But I believe it was the right thing to do. Not only to lift America out of economic crisis caused by a pandemic, but set America on a stronger course for the future. And we did that. We don't take my word for it. Here's how Time magazine and other commentators describe the economy I'm leaving to my successor. And there's a number of these quotes. President-elect Trump is receiving the strongest economy in modern history, which is the envy of the world.
U.S. Treasury Secretary Janet Yellen has expressed concern that President-elect Donald Trump's proposed broad import tariffs could hinder inflation control efforts and increase costs for consumers and businesses. Yellen warned that the tariffs up to 60% on Chinese imports and 10% to 20% on other goods could raise prices and harm the U.S. competitiveness. She also emphasized the need for Congress to find offsets to extend Trump's 2017 tax cuts set to expire in 2025 to ensure fiscal sustainability.
Over the past 2 days, I have had the chance to do just that. I've met with Premier Lee.
Amid a complex economic landscape, U.S. Treasury Secretary Janet Yellen has raised fresh concerns about the potential impact of President-elect Donald Trump's proposed import tariffs on inflation and economic stability. The Treasury Secretary also expressed concerns about the broader economic impact, emphasizing that higher tariffs could undermine the competitiveness of U.S. businesses and stifle growth. Yellen warned that the tariffs, which include a 60% levy on Chinese imports and 10 to 20% on goods from other trading partners, could derail recent progress in controlling inflation. Consumer prices, already showing signs of a slight uptick, could climb further, adding strain on American households. With inflation holding at 2.7% and core inflation steady at 3.3%, the Federal Reserve is widely expected to cut interest rates by 25 basis points at its meeting next week. Yellen has underscored the need for careful policy moves, as tariff-related cost pressures could complicate the inflation outlook. Yellen also highlighted broader fiscal challenges, warning that extending the 2017 tax cuts without offsets could add $5 trillion to the U.S. deficit over the next decade. As the U.S. economy navigates these challenges, Yellen has reiterated the importance of maintaining the Federal Reserve's independence.
And joining us today from Washington is the economic expert, Mr. Peter Tanos, to discuss the recent U.S. economic data, potential tariffs, and its effect on economic outlook. And welcome to Qnews. It's really nice to have you at the Economic Bulletin. Let me start off by asking you, what would be the latest U.S. inflation data that has just been released today? What is your initial thoughts on the figures, and what key trends do you observe?
The 2.7% number that you mentioned that was released this morning is high, but it is within the expectations of the economic community. So there was no bad surprise here. There were increases in prices in certain food items like eggs. Automobiles have also gone up in price. But the main news here is that the number was what was expected, and that's why today the stock market continues to rise.
And we've heard that President-elect Donald Trump is proposing significant tariffs on imports from countries like China and Canada. What impact could these measures have on consumer prices and the U.S. inflation, Mr. Tanos?
Yeah, this, of course, has been talked about quite a bit. And you quoted Secretary of Treasury Janet Yellen explaining that these would be inflationary and could cause serious problems to the economy. What I find amusing about that is that a first-year economics student could have made the same statement and could have made the same comment. It is obvious that imposing a 10 to 20% surtax, which is what a tariff would be, on items coming into the United States is going to raise prices, and that is inflationary. So don't count on it. This is more likely a starting negotiating position than a fait accompli.
And given today's inflation data and the ongoing tariff discussions, do you expect the Federal Reserve to maintain its course of rate cuts, or could we see a pivot in strategy, maybe?
Yeah, so as you, I think, correctly said earlier, there is a very high probability of a 25 basis point rate cut when the Fed meets next week. What is much more interesting to all of us is what the Fed's outlook is going to be for next year, because just a couple of months ago, we were expecting further rate cuts well into 2025. That may not be on the table anymore, and that is what investors are going to be looking towards. Is the cut next week, if it comes, going to be one and done, or are we going to be looking forward to more rate cuts? The jury is still out on that, and there's a chance that there may not be many rate cuts after the next one.
And Secretary Janet Yellen has expressed concerns about the impact of tariffs on the U.S. business competitiveness. Do you agree with her assessment?
Yeah, of course I do. And as I mentioned earlier, a first-year economics student would agree with her. it is obvious that imposing tariffs on everything the United States import is going to raise prices. That is obvious. And and if we raise prices, that's going to increase inflation. So don't count on it. As I said earlier, this is more likely a beginning negotiating stance than a fait accompli. But obviously there's concern about it because a lot of our trading partners think that Trump may just be crazy enough to do it. But if he is, he's crazy like a fox. I think he's negotiating.
And Mr. Tanas, can you actually share with us which industries do you think or sectors in the U.S. economy are most likely to feel the impact of these tariffs?
Well, if we're talking about a 10% increase in the tariffs on everything we import, it's going to affect just about every industry where imports are significant, and that's pretty much across the board. Also, remember, he's talking about a 60% tariff on imports from China. We import $500 billion worth of goods from China, covering a whole wide spectrum of items and industries. So the effects would be totally across the board.
And what are the key risks to the economic stability in 2025, particularly if tariffs are implemented and inflationary pressures persist?
I'll tell you the two biggest ones. One,
Yes.
the one you just mentioned, tariffs and inflation, number one. But the biggest problem we are going to face in the next 12 to 18 months is the cost of the interest on the national debt. We are paying over $800 billion just in interest costs on the national debt today, and that number is going to go up. To give you an idea of how big that is about the same size as the budget for the national defense, the same size as the $850 billion annual budget for the Defense Department. So I think this is going to be a serious problem.
Well, thank you so much, Mr. Peter Tanas, the economic expert from Washington. Thank you so much for sharing your insights with Qnews, our economic bulletin. And now we move to the world news. And in Asia, Japan's wholesale inflation rose to 3.7% year-on-year in November, marking the fastest increase since July 2024. This marks the third consecutive monthly rise, driven by higher food, non-ferrous metals, and plastic good prices due to rising commodity and labor costs. The corporate goods price index hit a record high of 124.3, keeping pressure on the Bank of Japan to consider raising interest rates at its next policy meeting on December the 19th. And according to data released by the General Administration of Customs, in the first 11 months of 2024, China's imports and exports with major trading partners maintained growth momentum. According to the administration, the value of China's foreign trade in goods increased by 4.9% year-on-year to reach 39.79 trillion yuan in the first 11 months of this year. The data showed trade with Belt and Road countries increased by 6%, and totaling to an 18.74 trillion yuan. Notably, imports and exports with the ASEAN countries rose to an 8.6%, while those with the EU, US, and South Korea grew by 1.3%, 4.2%, and 6.3%, respectively. And still in Asia, Thailand's cabinet has approved measures to support households and small businesses facing debt, including interest suspensions and reduced principal payments to address debt sustainably. With the household debt at 89.6% of the GDP, which marks almost $482 billion, the government seeks to alleviate its impact on consumption and growth. The plan covers loans of up to 5 million baht for housing and 800,000 baht for cars and smaller business loans. Banks will also contribute less to the Financial Institutions Development Fund for 3 years. The Finance Ministry forecasts fourth quarter growth at 4% and a full year growth at 2.8% in 2024. And India's new central bank governor, Sanjay Malhotra, has pledged to prioritize stability and continuity in policy making to support the economy. Speaking in Mumbai after assuming a 3-year term, Malhotra emphasized the importance of consistent policies over frequent changes. Earlier this month, under Das's leadership, the bank kept interest rates steady while easing banking system liquidity. And in Europe, Poland will focus on securing joint EU financing for defense during its 6-month presidency with Finance Minister Andrzej Domanski, emphasizing security as a shared European responsibility. The European Commission estimates that strengthening the EU's defense capabilities will cost €500 billion over the next decade. EU finance ministers will discuss funding options in April in Warsaw, with potential models including the EU budget or a special purpose vehicle. Domanski called for more efficiency and cooperation, highlighting Europe's 12 different tank systems as a key area of concern. France's economy is set to stagnate in the fourth quarter following an 0.4% growth in the third quarter, fueled by tourism from the Paris Olympics. The central bank projects an 0.2% drag on Q4 growth due to the post-Olympic pullback. Business sentiment is mixed, with moderate expansion in services but declines in industry and construction. Some leaders warn France's economy may already be in recession. The collapse of Prime Minister Michel Barnier's government over a budget dispute has added further uncertainty. The U.S. Treasury Department has transferred $20 billion of a $50 billion G7 loan for Ukraine to a World Bank fund. This fulfills a commitment to match the EU's aid for Ukraine, aimed at supporting the country's economic recovery amid Russia's military operations. The transfer is intended to protect the funds from potential future cuts under President-elect Donald Trump's administration, who has criticized U.S. aid to Ukraine. The funds will be managed by the World Bank's new Fortis Ukraine Fund, which focuses on non-military support.
You should keep in mind that there's a European support of 50 billion euros. There's the American support of 60 billion.
And moving to the MENA region, where the latest data released by the World Bank Lebanon Economic Monitor showed that Lebanon's real GDP growth has been cut by an estimated 6.6% in 2024 as a result of the conflict. This brings the cumulative decline in real GDP since 2019 to more than 38% by the end of this year. Data from the report also projects economic activity to contract by 5.7% in 2024, equivalent to a loss of $4.2 billion in consumption and net exports. GDP would have growth, albeit tepidly, by an estimated 0.9% in 2024 if the conflict had not broken out. Last month, the World Bank predicted Lebanon's physical damage and economic losses from Lebanon conflict to around $8.5 billion. OPEC has lowered its 2024 global oil demand growth forecast to 1.61 million barrels per day from 1.82 million barrels per day, marking its fifth consecutive reduction. OPEC also cut the 2025 forecast to 1.45 million barrels per day from 1.54 million barrels per day. The weaker outlook presents challenges for OPEC Plus. Earlier this month, OPEC Plus delayed its plan to increase output until April 2025 due to falling prices. ExxonMobil has announced it will increase annual project spending to range from $28 billion to $33 billion between 2026 and 2030, aiming to boost oil and gas output by 18%. The company plans to fund expansion in oil and LNG production, targeting 5.4 million barrels per day by 2030. Exxon aims to triple production in the Permian Basin to 2.3 million BPD and reach 1.3 million BPD from its Guyana operations. Oil prices rose after the European Union agreed a further package of sanctions targeting Russia's shadow fleet. Brent crude futures were up to 0.62% to $72.64 a barrel. U.S. West Texas Intermediate crude future rose to an 0.89% to $69.20. Gold prices rose after inflation data came in line with market expectations, boosting the likelihood of a Federal Reserve rate cut next week. Spot gold climbed an 0.3% at $2,700.87 per ounce. U.S. gold future rose to an 0.6% to $2,733.60. European markets opened lower and Asian stocks were mixed following a decline in the U.S. indices as investors digest recent U.S. consumer inflation data. In the United States, the S&P 500 gained an 0.6%, the Dow Jones Industrial Average edged down by an 0.1%, and the Nasdaq Composite climbed a 1.3%. And in Europe, Germany's DAX was a little changed. The CAC 40 in Paris edged down less than 0.1%, and Britain's FTSE 100 lost an 0.3%. And in Asia, the Hang Seng in Hong Kong lost an 0.8%, the Shanghai Composite Index advanced an 0.3%, the Kospi added a 1%, and Japan's benchmark Nikkei 225 was a little changed. And that's all for now, and here's a roundup of today's key headlines. Inflation in the United States rises to 2.7% in November. World Bank estimates Lebanon's real GDP growth has been cut by 6.6% in 2024. OPEC lowers its 2024 global oil demand growth forecast to 1.61 million barrels per day. And that was all for today's economic bulletin on Q News, and do stay connected for more news and updates.